Hey, what's up guys? Welcome to another episode of Real Life CFA. In this series, we're going to talk about all the important concepts in the CFA curriculum and real life applications.
So the topic for today is dividends and dividend growth. As always, let's start with the definition. What's a dividend? A dividend is the distribution of some of a company's earnings to its shareholders. Basically what it means is that a company pays a portion of the earning to shareholder as cash. Some companies pays monthly, some companies pays quarterly. It depends on the company's dividend policy. So how do you calculate dividend? Here are some formulas. Dividend payout ratio is equal to dividends paid divided by net income. So what is dividend payout ratio? It is basically the percentage of the company's earning that it will pay out to its shareholders as dividend. And the dividend payout ratio is equal to 1 minus retention ratio. What is retention ratio? It is the percentage of the earning that the company decides to keep in its pocket for future investments. It can be calculated by taking earning per share minus dividend per share and the whole thing divided by earning per share. For example, if a company's annual EPS is $3 and the dividend is $1. So the dividend payout ratio will be 1 divided by 3, which is around 33%. And the retention ratio will be 1 minus dividend payout ratio, which is 33%, which gives you 67%. So the next important question that we're going to look at is high dividend yield a good sign? Because what I found was a lot of investors, they focus on dividend yields when they are building their dividend portfolio. People will pick stocks with the highest dividend yield as possible. Is that a good strategy? We'll see. So to calculate dividend yield, you need to take the annual dividends paid per share divided by price per share. So it's basically the dividend per share as a percentage of price per share. From this formula, we can see that there are mainly two drivers for a high dividend yield. The first would be a significant decline in price per share. Is that a good thing? Absolutely not. A significant decline in price per share can reflect a fundamental problem for the company. Usually when this happens, the company will soon cut its dividend because now the company might need more cash to continue its operation. And the first thing that they're going to do is to cut dividends, because dividend is a cost to companies. What else can cause a high dividend yield? When a company increases its dividend payout ratio, it will also cause a high dividend yield because now the company pays more dividends. But is that a good thing? I don't think so. Although a higher payout ratio means more money goes to shareholders, but it also means that the company now has less money to support its growth, which will further lead to a slower growth. That is not good for the company. So to build a dividend portfolio solely based on how high the dividend yield is not a good idea. You also need to consider the growth of this company. So now let's introduce another important concept that I think every dividend investor should incorporate it into their strategy. That is the dividend growth. What's dividend growth rate? The dividend growth rate is the annualized rate of growth that a stock's dividend undergoes over a period of time. How do you calculate it? It's simple. You basically just take this year's dividend, divide by last year's dividend, and minus 1. Then you'll get the dividend growth rate. Why is this important? Because for most companies, they tend to keep their payout ratio stable, which means if the dividend growth of the company has been 10%, the EPS of the company should also be growing at 10%. So a high dividend growth rate with a stable payout ratio should be what dividend investors always look for. It does not just tell you the security of the dividend payment that you're getting, it also tells you about the growth of this company. So which one's better? Number one, a stock with 7% dividend yield but with no dividend growth. And second, a stock with 3% dividend yield but with a 15% dividend growth rate. Well, in my opinion, this is an easy question. I would definitely pick number 2. Even though right now, this stock may be paying less dividend, but its dividends is growing at 15% annually, which tells me the company's earnings is also growing around 15% annually. And the other stock, even though it's paying a 7% dividend yield, but with no growth. Dividend growth rate can also be reflected in stock prices. Very often when you hear a company announces hikes on its dividend, you'll see the stock price of this company go up. So the purpose of this video is to urge dividend investors to start looking at dividend growth rate instead of just focusing solely on dividend yield. Because dividend growth rate can tell you so much more about this company's fundamental strength than the nominal dividend yield. And very often, a high dividend yield is not sustainable because you have to understand that dividends are expenses to a company. When the dividend yield gets too high, it becomes a burden. But dividend growth rate is another story. As the dividend grows, the share of the price also grows. So the dividend yield of a high dividend growth rate company would not be impacted so much. Alright, that's all I need to say about dividend and dividend growth.
If you think this video is helpful and wish to watch more contents like this, please like and subscribe. Thank you very much for watching, and I'll see you next time.